All right, in this lesson, we're going to be looking at stock issuance. We're going to look at the journal entry, and then we're going to look at the mechanics of issuing stock to the public. So let's get started with helping you understand stock issuance. So the first thing that you have to understand is kind of how the stock issuance works. So if we have a graph here, we've got the corporation who will issue stock to their initial shareholders, or sell stock to the initial shareholders. Now we have a specific word that goes along with this. You might hear of an initial public offering or an IPO. So when the company first issues shares to their shareholder, usually to the public, we call that the initial public offering. Then any subsequent sale by the company to shareholders is called the seasoned new issue. So all of it meaning the same thing, is that the company is issuing stock to the shareholders. The first instance that it's sold to a public audience, we call that the initial public offering, or the IPO. You might hear it as IPO. And then any subsequent issuance to the public on new unissued shares would be called seasoned new issue, because they are new issued stock to the public. Now, once the stock is in the hands of the initial shareholder, the shareholder can pretty much do anything they want with those shares, specifically selling them to someone else when they no longer want to own the company. Now, they don't sell it back to the company unless the company is doing a buyback. Instead, they'll go to their brokerage account and they will sell their stock. When they sell their stock, someone else on the other end will buy it from them. In that case, it would be a new shareholder or a subsequent shareholder. That transaction is called the secondary market. So usually for most people, we're not actually buying shares from the company, we are buying them from the market, and it's the secondary market. Why is it the secondary market? Because someone else owned it before, and that person has now sold it to you in the secondary market. So when an IPO happens and you go to a brokerage account and go, hey, I'm going to buy X, Y, and Z company because they're issuing shares today, you're really not buying it from the company. You're buying it from someone else who owned it at the point at which those shares started trading, usually. So when that happens, you're actually buying it secondhand from someone else. Traditionally, in order to participate at the IPO level, so this is this person right here, you usually need to have like a high net worth. Usually these have a very good relationship with their brokers, and their brokers have a good relationship with kind of this IPO listing kind of a thing. So it's really hard for everyday people to get into the IPO because you kind of need to have assets. And a lot of times IPOs are really only, or I should say, people who purchase initial public offerings are usually big mutual fund companies. They are big investment companies who are buying a ton of shares for their own shareholders by way of owning a mutual fund. So mutual funds buy shares of companies, and typically they'll go to these roadshows and put in orders for these large sums so that when they issue them at the IPO, they're buying it at that price, and then they turn around and either sell it or keep it in their mutual fund as part of their investment portfolio. So it's really hard to get into there. Most people trade at this level here, the secondary market. So kind of reviewing what we learned in the last lesson to help us get us to the journal entry in this lesson. So assume a company issued one share for $15 with a par value of $1. We said in the last lesson it would look something like this. We have $15. When the company receives $15, $1 of it, the par value, will go into the common stock account. The rest of it will go into this new account called the additional paid in capital. So that's what we have here. And so what we're going to do now is show you what the journal entry is for stock issuance. And we've done this before in another part of this course, but specifically here, we're now throwing in the par value. So we're going to mix it up just a little bit from the journal entry standpoint. So assume company A issued 5,000 shares at a total price of $15 per share with a par value of 25 cents. So what is the journal entry for this? So what we have to do is we have to figure out how much the company actually received from the issuance of 5,000 shares. So we're going to do some math here. So we're going to do 5,000 and we're going to multiply it by $15 and that's going to give us $75,000. So we got $75,000 in cash that we are getting. Now we need to separate this between par value and common stock and additional paid-in capital, because there is a par value. So to get the par value amount, we're going to do 5,000 times a quarter, and we are going to get $1,250. So we're going to put $1,250 in the common stock. So then now to get the additional paid-in capital, we're going to need to take the $75,000 in cash and put it somewhere else, or part of the $75,000 in cash and put it somewhere else. Well, how much someone else is going to be is 75,000 minus 1250. So if we do 75,000 minus 1250, we get $73,750. So we know that 1,250 is going to go to common stock. The rest is going to go into additional paid-in capital. Why? Because this has a par value. The par value amount for each share goes into common stock, whereas the rest goes into APIC. So the question is, what's our journal entry? Well, we know that we're going to receive cash, and we're going to receive cash in the amount of $75,000. So if we receive cash, that is a debit to cash. So we're going to debit cash in the amount of $75,000. And now we need to credit. What are we going to credit? Well, we're going to credit common stock like we've done in the past in the amount of $1,250. And then we're going to credit additional paid-in capital. I'm going to abbreviate here just for space reasons. Additional paid-in capital of $73,750. So that's what our journal entry would look like. Debit cash for $75,000. Credit common stock for the par value of $1,250, and crediting additional paid-in capital of $73,750. All of our numbers should tie at this point, and therefore our journal entry is complete. So that's what it would look like on a stock issuance when we have par value. If we don't have par value, in this case, we would have debited cash and credited common stock, and we wouldn't have additional paid-in capital. So that is a look at stock issuance, what the journal entry would be for the stock issuance, and just understanding how we break up the par value from the additional paid-in capital when we do have a par value issued stock. So I hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or click in the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.